I must say I'm in my old age reaching a point where I have a little trouble convincing myself that the stock market is that important, and that we live in an age where some much more important issues are playing out. And I know Ray shares that view to some considerable degree. But I view the stock market now really as a hobby. And the one thing that I have kept going is resources and climate change related investing, and also, for old time's sake, investment bubbles, since I've been doing that for 40 or 50 years. And since I find myself unexpectedly in the third great investment bubble of my career, basically in the US. So I can't avoid it. And this is a wonderful day to be having this discussion. It's not only Victory Over Hitler in Russia Day, but it's also a day where the market is showing signs of breaking down. Through yesterday, it's the worst opening of a year for the S&P since I was 1 year old in 1939. I am a pre-war baby, unlike Ray. And of course, the NASDAQ is down as we speak, 27.5% from its high, and the Russell 2000 about 23, S&P about 15.5. So it's getting to be interesting. And as we were saying before, Bitcoin from some point in the last 24 hours is down 10% to 32,000 and change. So that is getting interesting. And ARK, Kathy Wood's wonderful instrument, is back to it where it was in 2018. I'm not kidding you. It is back below this entire event now, which is quite remarkable, down 75% from its peak, as is AMC, down 75% from its peak. And the other meme stocks are in ragged disarray. So this is the real McCoy, seems to be playing out pretty close to 2000.
And I'm just wondering how you're assessing all of this in the context of your research on asset bubbles.
Always considered myself a fairly serious amateur historian. And what I've done in bubble territory is I don't try and build models to explain every day, as you guys do. I focus on the four great bubbles, which are characterized by nearly hysterical behavior, really seriously weird over-optimism, which is very rare, and which are characterized by accelerated price moves on the upside, and by a weird deviation on the upside between the blue chips going up and the risky stocks going down. And that is rare as hen's teeth. It happened brilliantly in 29. It happened during the year 2000, again in spades, with the S&P X growth continuing to go up through September of 2000, and the growth stocks basically going down 50%, and the internet stocks dropping maybe 60, 70% by then. So that was spectacular. And we saw a very handsome deviation between the S&P rising last year and the Russell 2, for example, dropping quite handsomely. So there was a 20, 25 point spread on the upside. And that for me is a pretty good indicator. And I tell you what it describes. It describes Mr. Prince's "I've got to keep dancing because the music's still playing." And we understand that completely, the enormous commercial imperative of the industry to play up to and over the edge. But they're not complete idiots. And so they say, well, I've got to keep dancing, but I don't have to keep dancing with Puma Tech, the most advanced stock in 99. I'm going to transfer to Coca-Cola. And I'll keep dancing it off the edge, but I'll go off with Coca-Cola. And it works. The Coca-Colas may be handsomely overpriced, but in 1929 and 2000, 2001, and so on, they always go down a lot less as the bubble breaks. And that's the phenomenon that causes this very rare indicator of impending doom, which we saw last year. And so by early this year, it seemed clear to me that this was not only the real McCoy bubble, which had been clear for a year or so in terms of pricing and enthusiasm, but it had triggered this very rare indicator of impending doom. In other words, now. And so our piece of a year and a bit ago was called Waiting for the Last Dance. And our equivalent follow-up this January was Let the Wild Rumpus Begin, i.e., we're in it, dudes. And I do believe we are. And I believe the declines will be very substantial.
Ray, why don't we turn it to you now? I want to get your thoughts on how the trends you and Jeremy have been describing and have identified are likely to play out. What do you see over the next, let's say, 5 to 10 years in terms of some of these big inflection points that we may be going through?
I think that looking at it year by year, this is the third year of the expansion with a very aggressive monetary policy, and so we're in the part of the typical expansion where there's a lot of inflation pressures because it happened in a giant big way, and everybody's long. The world it's the end of a paradigm because everybody believes that they want everything to go up. And of course, that creates a dynamic where policy is long, everything goes up. And of course, that happens by creating money and credit, debt, which creates debt. And that dynamic means that you must have a decline in real wealth measured by that, because that's the financial wealth has become enormous relative to the real wealth. Everybody who's holding bonds or assets, particularly the debt assets, believes, or financial assets in general, which are just journal entries, they're claims, but they believe that they can take that buying power and sell it and buy goods and services, and they can't. And by its necessity, there must be negative real returns, negative returns relative to buying power. So